The reserve currency Deathwatch. 4 currencies died this way. Dollar is showing all 4 signs. Now there's a moment in monetary history that repeats with surgical precision. A moment when the world's dominant currency, the one that underwrites global trade, finances governments, and anchors the international system, begins its terminal decline. It happened to the Dutch guilder in the 1720s when Amsterdam's financial supremacy crumbled. It happened to the British pound in the 1940s when London lost its grip on global commerce. It happened to the German mark in the 1920s when Weimar's printing press destroyed a century of trust. And it's happening right now to the US dollar in 2025. But here's what makes this different, what makes this moment more dangerous than any previous reserve currency collapse. The dollar isn't just America's currency. It's the foundation of the entire global financial architecture. $13 trillion in international debt is denominated in dollars. $6.8 trillion in daily foreign exchange transactions flow through dollars. Central banks hold $7 trillion in dollar reserves. When the dollar dies, it won't be one nation's problem. It will be civilization's problem. And the signs aren't subtle, they're screaming. Every reserve currency that failed showed 4 distinct warning signals before its collapse. 4 mathematical certainties that appeared in sequence, each one accelerating the next, until the currency that had ruled the world became worthless paper. The Dutch guilder showed all 4 signs before it fell. The British pound displayed them perfectly. The German mark exhibited them catastrophically. And right now in 2025, the US dollar is showing all 4 simultaneously. This isn't speculation. This is pattern recognition. And once you see it, the trajectory becomes undeniable. Let me take you back to 1720 Amsterdam. For nearly a century, the Dutch guilder has been the world's reserve currency. Amsterdam is the financial center of the known world. The Bank of Amsterdam, founded in 1609, holds gold and silver backing its currency. Dutch merchants control global trade routes. Their ships move spices from Asia, timber from Scandinavia, sugar from the Caribbean. Every major transaction, every international contract, every significant loan, it's denominated in guilders. The Dutch have built this supremacy on trade dominance, financial innovation, and most critically, trust. Trust that the guilder will hold its value. Trust that Amsterdam's banks won't default. Trust that the currency backing is real, but trust, once established, is fragile. And by 1720, cracks are appearing that few notice but that will prove fatal. Sign 1, the first warning of reserve currency death, massive expansion of credit disconnected from productive capacity. The Bank of Amsterdam begins something that will seem brilliant until it proves catastrophic. They start lending out more guilders than they have gold and silver to back. Not slightly more, massively more. Their reserve ratio, the amount of precious metal backing each guilder, falls from 100% to 60%, then 40%, then lower. They're creating money from nothing, backed by nothing but the assumption that everyone won't demand their gold at once. Why? Because the Dutch East India Company needs financing. Because the government needs money for wars. Because merchants want credit for increasingly speculative ventures. And because, critically, nobody believes the guilder can fail. It's been the reserve currency for generations. It's backed by the most sophisticated financial system in the world. It's Amsterdam. Of course it's safe. But here's what's really happening beneath the surface that will become obvious only in hindsight. The guilders being created aren't funding productive trade anymore. They're funding speculation. The South Sea bubble is inflating across Europe. Dutch investors are borrowing guilders to buy shares in companies with no earnings, no products, just promises. The Mississippi Company in France trading at insane valuations. British joint stock companies issuing shares for ventures that don't exist. And Dutch tulip mania, though technically earlier, has established a culture where speculation is confused with investment. The money supply is exploding, but it's not creating real wealth. It's creating paper wealth that will vanish the moment confidence cracks. By mid-1720, the guilder's fate is sealed, though nobody knows it yet. When the South Sea bubble bursts in September, the cascade is immediate. Investors need to sell anything liquid to cover losses. They demand gold from the Bank of Amsterdam. The bank can't pay, they don't have it. The reserve ratio they claimed was a lie, And when that truth emerges, when people realize the reserve currency isn't actually reserved, the panic is absolute. The guilder doesn't gradually decline, it collapses. Within months, Amsterdam loses its status as financial center of the world. The guilder continues to exist, but as a shadow of itself, never again trusted to underwrite global trade. Now watch this same pattern with the British pound, but accelerated and magnified. For over a century, from the defeat of Napoleon to World War II, the pound sterling is the unquestioned reserve currency. London is the world's financial capital. The City of London's banks finance railways in Argentina, mines in South Africa, governments across Asia. British naval power enforces a global trading system denominated in pounds. The gold standard, which Britain champions, means pounds are as good as gold because they're convertible to gold at a fixed rate. Sign 1 appears during World War I. Britain finances its war effort by printing money. The government issues debt. The Bank of England buys it, creating pounds from nothing. By 1918, the British money supply has tripled. They've broken the gold standard during the war years, printing far more pounds than they have gold to back them. And though they return to gold in 1925, it's at an overvalued rate that proves disastrous. The pound is backed by faith more than metal. But here's sign 2, the warning that follows inevitably from sign 1. Persistent trade deficits that drain reserves. When you're the reserve currency, you have a unique privilege. You can buy foreign goods with your own currency. You print pounds. Foreigners accept them because pounds are trusted, and you accumulate foreign goods without giving up real assets. It's the ultimate free lunch, but it only works if foreigners want to hold your currency. If they believe it will keep its value. If they trust you won't print too much. By the 1930s, Britain is running persistent trade deficits. They're importing more than they export. The empire is no longer generating enough surplus to finance London. And crucially, other nations are starting to demand gold instead of pounds. France is especially aggressive, converting pound reserves to gold, draining the Bank of England's vaults. The United States is rising as an economic power, producing more, trading more, and increasingly unwilling to accept pounds as payment when they can demand gold. Here's why this matters. When you're the reserve currency, your trade deficits aren't just an economic issue, they're a trust issue. Every deficit means you're sending your currency overseas, and if that currency isn't backed by the productive capacity to earn it back, if you're just printing it, then eventually foreigners will realize they're holding paper promises from a nation in decline. They'll want out. They'll want gold, and you won't have enough gold to pay them all. Sign 3 appears next, and it's the most visible warning: geopolitical overextension that bleeds resources faster than the economy can generate them. Britain in the 1940s is defending an empire that spans a quarter of the globe. Military bases in Egypt, India, Singapore, Africa, the Caribbean, naval forces on every ocean, commitments to protect territories that no longer generate profit, that have become liabilities rather than assets. World War II costs Britain everything. They fight magnificently, survive the Blitz, stand against Hitler when standing alone seemed suicidal. But the cost is catastrophic. By 1945, Britain owes the United States $4.3 billion in war loans. They owe India, Egypt, and other colonies billions more in sterling balances, essentially IOUs issued to finance the war. The nation is broke, the empire is unsustainable, and the pound, backed by a bankrupt nation defending an empire it can no longer afford, is living on borrowed time. The final collapse comes with sign 4, the emergence of a credible alternative reserve currency. The US dollar, backed by the world's largest economy, the only major industrial power untouched by war's destruction, becomes that alternative. At Bretton Woods in 1944, the new monetary order is established. Dollars, not pounds, will be the anchor. Dollars will be convertible to gold at $35 per ounce. Other currencies will peg to the dollar. The pound is relegated to secondary status. And though Britain tries to maintain the fiction of great power status, by 1949, they're forced to devalue the pound by 30%. By 1967, another devaluation. The reserve currency that ruled for a century dies not suddenly, but through managed decline, death by 1,000 cuts. By the 1970s, it's over. The pound becomes just another currency, and Britain becomes just another country. Now let's talk about the German mark, because its death is different, faster, more violent, and contains a warning about what hyperinflation actually looks like. Post-World War I, Germany faces impossible reparations payments demanded by the Treaty of Versailles. 132 billion gold marks, an amount that exceeds Germany's entire GDP. Sign 1, credit expansion, happens at velocities never seen before. The Reichsbank begins printing marks to pay the debts. Not gradually, exponentially. In 1919, 29 billion marks in circulation. By 1921, 81 billion. By 1923, 497 quintillion marks. That's not a typo. Quintillion. The printing presses run day and night. New denominations are created weekly. 1 million mark notes, 1 billion mark notes, 1 trillion mark notes. The currency becomes wallpaper, literally. Germans use marks to fuel their stoves because it's cheaper than buying firewood. Sign 2, trade collapse is instantaneous. No foreign nation will accept marks as payment. German imports must be paid in gold or foreign currency, which Germany doesn't have. The country is cut off from international trade, surviving only on what it can produce domestically. Sign 3, geopolitical humiliation, is complete. Germany has lost the war, lost territory, lost its military, lost its sovereignty. The nation that was an industrial powerhouse in 1914 is an occupied debtor by 1919. And sign 4, the alternative, is every other currency. Anything is better than marks. Germans who can hold dollars, pounds, Swiss francs, even French francs despite hating France. By 1923, a loaf of bread costs 200 billion marks. Workers are paid twice daily because prices rise hourly. The middle class is destroyed. Savings become worthless, social order collapses, and from this chaos extremism rises. The hyperinflation of the Weimar Republic doesn't just destroy the mark, it destroys faith in democracy itself, paving the way for what comes next. 3 currencies, 3 collapses. 3 times the same 4 signs appeared in sequence, and now the US dollar in 2025 is displaying all 4 simultaneously. Let's go through them with precision, because this isn't theoretical, this is happening right now. Sign 1, massive credit expansion disconnected from productive capacity. Check. The Federal Reserve's balance sheet was $900 billion in 2008. Today it's over $7 trillion. That's not economic growth. That's money printing. The M2 money supply has increased 40% since 2020 alone. The federal government has added $15 trillion in debt in the last 15 years, debt that will never be repaid, only rolled over at higher interest costs. And crucially, this money isn't building factories or funding innovation. It's financing consumption, buybacks and speculation. The disconnect between money supply growth and GDP growth is the widest in American history. We're creating dollars faster than we're creating value, which is exactly what Amsterdam did before the guilder collapsed. Sign 2, persistent trade deficits draining reserves. Check. The United States has run trade deficits for 50 consecutive years, half a century of importing more than we export, sending dollars overseas in exchange for goods we consume rather than produce. In 2024, the trade deficit exceeded $900 billion. Every year, nearly $1 trillion flows out to foreign holders. And those foreign holders are starting to ask the question that kills reserve currencies. Why are we holding dollars? China, holding over $800 billion in treasury securities, is reducing its position. Saudi Arabia, after 50 years of pricing oil exclusively in dollars, is now accepting yuan, rupees, euros. The petrodollar system, which created infinite demand for dollars by forcing oil importers to buy dollars first, is fracturing. When OPEC nations no longer require dollars for oil, a pillar of dollar dominance disappears. Sign 3, geopolitical overextension bleeding resources. Check. The United States maintains over 750 military bases in 80 countries. We spend more on defense than the next 10 nations combined, over $850 billion annually. We're fighting proxy wars in Ukraine, maintaining commitments in Taiwan, defending shipping lanes globally, underwriting NATO, protecting Japan and South Korea. The empire is costing more than the economy can sustain. And critically, these expenditures aren't generating returns. We're not extracting resources or tributes from these commitments. We're hemorrhaging money to maintain a global order that fewer nations want and that we can't afford. The parallel to Britain in 1945 is exact. An empire maintained by debt, defended by deficit spending, sustained by the assumption that the reserve currency can never fail. Sign 4, the emergence of credible alternatives. Check. This is the final and most dangerous sign. China and Russia are settling bilateral trade in yuan and rubles, bypassing dollars entirely. The BRICS nations, Brazil, Russia, India, China, South Africa, representing 45% of the global population, are developing payment systems outside SWIFT, outside dollar control. Central banks globally are buying gold at rates not seen in decades, 1,000 tons per year. Diversifying away from dollar reserves, the digital yuan, China's central bank digital currency, is operational in pilot programs, offering a technologically superior alternative to dollar-based payment systems. And perhaps most tellingly, even US allies are hedging. Europe is discussing strategic autonomy, reducing dependence on dollar-denominated finance. Japan is diversifying reserves. The consensus that dollars are the only option is breaking. The pattern is complete. All 4 signs are present simultaneously, and history says what happens next. The collapse won't be gradual, it will be sudden. Not because of one event, but because reserve currency collapse is a phased transition. For years, decades even, cracks can accumulate invisibly. The system absorbs stress, adapts, continues functioning. But there's a threshold, a mathematical point, where the structure can no longer hold, and when that point is crossed, the collapse is instantaneous. For the guilder, it was the South Sea bubble. For the pound, it was Suez in 1956, when Britain realized it could no longer act without American approval. For the mark, it was the occupation of the Ruhr in 1923. For the dollar, we don't know yet what the trigger will be. A debt ceiling crisis that actually results in default. A major nation refusing to accept dollars for strategic resources. A military overextension that reveals American weakness. Or maybe just the slow accumulation of trade deficits and debt finally reaching the point where confidence breaks. But the mathematics say it's coming, not if. When? And when it comes, those who prepared will survive. Those who didn't will lose everything denominated in dollars, which in America is everything. I'll see you on the other side.